There were no headlines, no emergency press conferences, no visible collapse. Inside, secured vaults and settlement systems, contracts continued to clear, prices continued to print, and paper claims continued to multiply. On screens, liquidity appeared intact. In spreadsheets, exposure remained theoretical, but the system had already diverged. What was traded no longer resembled what could be delivered. What was priced no longer matched what could be sourced. The distinction between paper claims and physical metal, long treated as an accounting detail, became a fault line. This was not a shock. It was not a surprise. It was the delayed resolution of years of arbitrage, leverage, and institutional denial. The failure did not begin with default. It began with margin rules, settlement delays, and quiet exemptions, mechanisms designed to buy time, time that was already gone. As confidence thinned, the system did not break loudly. It narrowed, it slowed, it rationed. Liquidity became conditional. Delivery became negotiable. Force majeure became plausible. This narrative is not about what might happen. It is about what was set in motion long before the public was aware, and why, once begun, the sequence could not be reversed. What appeared to break was nothing dramatic. Prices moved, then stabilized. Volumes printed on schedule. Official indicators reported adequate liquidity. From the public's perspective, the market absorbed another bout of volatility and moved on. What actually happened was quieter. Behind the screen, settlement stress increased while visibility decreased. Paper claims continued to clear, but physical availability tightened. The dock and the screen diverged. One showed abundance, the other showed delay. The public saw price discovery. The system experienced signal suppression. Every completed trade reinforced the appearance of health, even as the underlying structure narrowed. Nothing failed. That was the problem. The mechanism followed a simple, repeatable chain. First, arbitrage incentives encouraged expansion. When paper prices diverged slightly from physical sourcing costs, institutions stepped in to capture spread, increasing paper issuance. Second, liquidity appeared to deepen. More contracts, more volume, tighter spreads on screen. Third, physical supply did not expand. It was finite, slow, and geographically fixed. Fourth, margin structures rewarded leverage. As volatility remained contained, margin requirements stayed low, encouraging larger positions with thinner buffers. The analogy is a queue. As long as only a few people stand in line, the system flows. When everyone assumes they can step out at once, the queue becomes a bottleneck. Not because demand spiked, but because capacity never changed. Liquidity was not removed suddenly, it was reclassified. Screen liquidity replaced physical access. Institutions with the most exposure relied on historical rollover assumptions, mathematically implied but never stress-tested at scale. Early stress produced subtle responses. Margins were adjusted at the edges. Position limits were discussed, not enforced. Volatility controls were framed as routine risk management. Each step reduced optionality. Higher margins forced weaker participants to reduce exposure, consolidating risk inside fewer balance sheets. Halts slowed price discovery, extending settlement windows. Rule clarifications reframed obligations without resolving delivery. History rhymes here. In past episodes, similar measures delayed resolution while increasing concentration. Stability was preserved on the surface by increasing fragility underneath. Force majeure was not declared. It did not need to be. The architecture was already moving in that direction. Away from the screen, signals accumulated. Dealer premiums widened while spot prices remained contained. Delivery times extended quietly, explained as logistics. Inventory reports showed stable totals, but composition shifted. Eligible metal increased. Registered metal declined. Industrial demand did not pause. It pressed forward, insensitive to screen volatility and dependent on physical continuity. Indications suggested that sourcing decisions were being pulled forward, not deferred. Silence dominated official channels. Signals persisted elsewhere. The market did not break. It normalized stress. And normalization is how systemic failure begins. What visibly broke was logistics, nothing more. A delayed shipment, a postponed vault transfer, a routine notice citing congestion or verification. What the public saw was administrative friction. What actually happened was a breach at the physical layer. Metal that was contractually available became operationally unavailable. Not missing, not defaulted, simply not moving. The screen continued to print prices and volumes as if access were unchanged. At the dock, access narrowed. This was not a market event. It was a procedural one. The failure occurred where paper obligation meets physical custody. And, because it did not announce itself through price, it remained invisible. The mechanism unfolded in a strict sequence. First, arbitrage incentives encouraged paper expansion. As long as physical conversion was assumed frictionless, issuing claims was profitable. Second, physical throughput failed to scale. Vault capacity, transport schedules, and verification timelines were fixed constraints. Third, liquidity was quietly removed, not from the screen, but from the exit. Delivery windows lengthened. Substitution became normalized. Fourth, margin pressure intensified upstream. As physical tightness increased basis risk, institutions hedging paper exposure faced widening mismatches. The analogy is a vacuum. Air continues to move until pressure equalizes. When the seal breaks, flow becomes one-directional. Paper flowed in. Physical stopped flowing out. Institutions with priority access drew first. Sovereigns, central counterparties, and systemically important banks secured allocation. Residual claimants remained technically whole but practically constrained. Exposure did not disappear. It concentrated. Initial responses were procedural, settlement flexibility, optional cash equivalents, temporary exemptions. Each measure reduced strain for some and increased it for others. Margin requirements rose selectively, forcing smaller participants to reduce positions. Halts were discussed to manage volatility, not delivery. Rule interpretations shifted to redefine what constituted fulfillment. The pattern is familiar. In 1980, delivery rules changed when concentration became inconvenient. In 2008, liquidity froze while prices continued to print. In 2022, the nickel market halted to prevent failure from becoming visible. Force majeure risk entered internal models before it entered language. Signals emerged away from official channels. Dealer premiums diverged from futures prices, not sharply, persistently. Delivery timelines extended beyond standard settlement cycles. Inventory reports showed stability in headline numbers, but registered metal declined while eligible categories rose. Metal present, but not committed. Industrial users reported sourcing challenges without price justification. Orders were filled partially. Lead times increased. Substitution was requested. Silence dominated public communication. Signals accumulated privately. The system crossed a line without acknowledging it, from abundance to allocation, from access to priority, from market to mechanism. What visibly broke was pricing coherence. Spreads widened, then stalled. Futures prices remained orderly while physical quotes drifted. The public saw inefficiency. Analysts called it dislocation. What actually broke was convertibility. Paper claims continued to circulate at scale, but the pathway to physical settlement narrowed further. Contracts that were mathematically equivalent stopped behaving as if they were interchangeable. The screen insisted on parity. The dock did not. This was not a price failure. It was a structural one. The causal chain was mechanical. First, arbitrage incentives encouraged claim multiplication. Each paper contract assumed access to a shared physical base. Second, as physical availability tightened, arbitrage stopped resolving divergence. Instead of compressing spreads, it amplified exposure. Third, liquidity was removed at the conversion point. Paper could trade freely, but redemption became conditional. Fourth, margin pressure emerged as basis risk increased. Institutions hedging physical exposure with paper instruments faced widening gaps that margins could not bridge. The analogy is a bottleneck. Traffic flows smoothly until lanes narrow. Speed remains high until it suddenly doesn't. The jam is not caused by demand, but by capacity that was always limited. Institutional exposure was layered. Bullion banks carried offsetting books, assuming netting would hold. Funds relied on daily liquidity that was mathematically implied, not physically guaranteed. Clearing members assumed diversification where correlation was absolute. The divergence was not accidental, it was structural. As divergence persisted, responses escalated. Margins were raised to manage volatility that was not the root problem. This forced liquidation of weaker positions, concentrating exposure further. Halts were considered to stabilize price action, freezing paper markets while physical stress continued. Rule changes reframed settlement obligations, allowing alternative fulfillment without resolving scarcity. Each step reduced transparency. Historical rhymes are clear. In 2008, collateral quality was redefined to preserve liquidity. In 2022, market halts prevented price discovery from revealing structural imbalance. In earlier metal crises, delivery rules were modified when physical claims exceeded tolerance. Force majeure shifted from improbable to modeled. Signals hardened. Dealer premiums became detached from futures curves. Delivery delays moved from weeks to months. Inventory reports showed a widening gap between total metal and deliverable metal. Eligible stocks rose. Registered stocks fell. Industrial demand intensified pressure. Fabricators could not hedge delivery risk with paper instruments. Physical sourcing decisions bypassed exchanges entirely. The screen continued to suggest liquidity. At the dock enforced scarcity. Silence persisted. Signals multiplied. At this stage, divergence was no longer reversible. It was self-reinforcing. What visibly broke was confidence between institutions. Credit lines tightened. Counterparty limits were adjusted. Risk committees met more frequently. The public saw routine risk management. What actually happened was coordinated retreat. Institutions closest to the physical layer began protecting access. Those further away began protecting balance sheets. The screen continued to function. The dock became guarded. This was not panic in the classical sense. There were no runs, no headlines. It was defensive synchronization. The mechanism followed a predictable sequence. First, arbitrage incentives reversed. What once generated profit now generated exposure. Holding paper claims without guaranteed physical exit became a liability. Second, liquidity was withdrawn institution by institution. Market makers reduced size. Bid-ask spreads widened quietly. Internal limits replaced public prices. Third, margin pressure accelerated contagion. Rising requirements forced deleveraging, not because positions were wrong, but because liquidity assumptions failed. Fourth, institutional exposure became visible internally. Netting assumptions broke down as correlated positions moved together. The analogy is a margin call. Not a sudden one, a rolling one. Each institution received it at a different time, but all responded the same way. Reduce exposure, preserve capital, secure access. As positions were unwound, liquidity did not reappear. It migrated upward, concentrating inside fewer balance sheets with preferential access to physical settlement. With stress now institutional, escalation accelerated. Margins were raised again, disproportionately affecting non-core participants. This reduced apparent open interest while increasing concentration risk. Temporary halts were introduced to manage volatility, slowing price discovery and masking physical strain. Rule changes followed. Settlement flexibility, extended delivery windows, cash alternatives normalized. Each step bought time by redistributing stress. Historical parallels are consistent. In 2008, interbank lending froze before markets acknowledged insolvency. In 2022, the LME halt preserved clearing members at the cost of market trust. Earlier metal crises followed the same pattern. Protect institutions first, obligations second. Force majeure entered contingency planning, quietly. Signals intensified outside official metrics. Dealer premiums spiked episodically, then stayed elevated. Delivery delays became variable and opaque. Inventory categories shifted sharply. Eligible stocks rose as metal avoided commitment. Registered stocks thinned toward operational minimums. Industrial users reported rationing without explanation. Contracts were renegotiated mid-cycle. Substitution increased despite cost. Silence from authorities continued. The system was no longer absorbing stress. It was managing exposure. At this stage, contagion was not spreading through price. It was spreading through behavior. And behavior had already changed. What visibly broke was consistency. Contract terms changed. Settlement language shifted. Notices were issued clarifying what delivery meant. The public saw governance. What actually happened was legal reframing under stress. Obligations that were once binary became conditional. Delivery was no longer a fixed outcome, but a process subject to interpretation. The screen continued to show enforceable contracts. At the dock, enforcement became discretionary. Nothing was canceled. Everything was softened. The mechanism was procedural, not chaotic. First, arbitrage incentives collapsed. When rules change mid-cycle, price convergence loses meaning. Paper claims could no longer rely on physical equivalence. Second, liquidity was removed through definition. Contracts remained liquid on screen, but illiquid in outcome. The exit was still listed. It was no longer assured. Third, margin pressure increased asymmetrically. Participants still subject to full delivery risk faced rising costs, while protected institutions operate under revised terms. Fourth, institutional exposure was legally insulated. Systemically important entities were shielded through rule interpretation rather than capital injection. The analogy is a contract rewritten while the queue is still forming. Everyone is still waiting, but the rules for reaching the front have changed. Force majeure did not need to be declared to function. Its logic was embedded. If delivery could be delayed, substituted, or monetized, then failure could be avoided in name while occurring in substance. Escalation now moved through formal channels. Margins rose again, justified by uncertainty rather than volatility. This forced further position reductions, shrinking participation without reducing outstanding claims. Halts became normalized tools, pausing discovery during moments of stress. Rule changes followed rapidly, expanded settlement windows, alternative fulfillment clauses, emergency discretion. Each step reduced legal clarity. History is unambiguous. In prior crises, rule changes marked the transition from market failure to institutional preservation. In 1980, position limits and liquidation-only rules resolved imbalance by fiat. In 2008, contractual certainty gave way to negotiated survival. In 2022, retroactive cancellations redefined market risk. Force majeure ceased to be an exception. It became a contingency. Signals hardened further. Dealer premiums detached completely from futures movements. Delivery commitments were quoted with caveats. Inventory data showed metal present but withheld. Eligible rising, registered approaching minimum viable levels. Industrial demand intensified pressure. Production schedules could not wait for legal reinterpretation. Off-exchange sourcing increased. Long-term contracts bypassed visible markets. Public communication remained measured. Technical, reassuring. But the signals were no longer subtle. Rules had changed because reality had already changed. At this point, the system was no longer pretending to clear risk. It was reallocating loss. What visibly broke was continuity. Deliveries occurred, but not as scheduled. Contracts settled, but not as written. Inventory reports remained positive, but usable supply thinned. The public saw endurance. What actually happened was exhaustion. Physical metal continued to leave transparent systems. Not in a rush, in a steady draw. Vaults remained staffed, screens remained active. But the pool supporting outstanding claims shrank below sustainable levels. This was not a sudden drain. It was an irreversible one. The mechanism was final and linear. First, arbitrage incentives vanished entirely. No spread justified the risk of non-delivery. Paper claims traded only because participants assumed others would accept them. Second, liquidity collapsed at the physical exit. Conversion was delayed, rationed, or substituted. The vacuum formed at the point of redemption. Third, margin pressure became existential. With no reliable hedge, institutions faced exposure that could not be neutralized. Capital buffers replaced risk models. Fourth, institutional exposure resolved through prioritization. Systemically important entities secured remaining access. Residual claimants absorbed the constraint. The analogy is depletion. A reservoir does not announce its end. Levels fall until pressure fails. Flow stops. Default risk did not arrive as an event. It emerged as a condition. When claims exceed deliverable supply, default becomes mathematically implied, even if legally deferred. At this stage, escalation was procedural. Margins reached prohibitive levels, suppressing participation. Halts became frequent, managing optics rather than resolution. Rule changes finalized discretionary settlement. Force majeure moved from planning to readiness. Each step reduced the probability of visible failure while increasing the certainty of structural loss. History offers no alternative ending. In every comparable episode, once physical backing fell below claim volume, resolution occurred through redefinition, not replenishment. The system was no longer stressed, it was constrained, signals converged, dealer premiums became the market. Delivery delays lost meaning as timelines dissolved. Inventory, categories were effectively symbolic, eligible without intent, registered without margin. Industrial users secured supply directly or reduced output. Visible markets lost relevance for physical sourcing. Silence persisted, but silence was the signal. The screen continued to display prices. The dock enforced reality. At this point, default risk was not a forecast. It was embedded.